Hey everyone, and welcome back to the Babalian Money Show. Today we re-diving deep into one of the most fundamental concepts in stock valuation, the dividend discount model, or DDM. Have you ever wondered how analysts figure out if a stock is a bargain or overpriced? Well, the DDM is one of the classic tools they use, and by the end of this video, you'll know exactly how it works, step by step. Before we jump in, a quick but important reminder. I am not a financial advisor, and this video is for educational and entertainment purposes only. Investing involves risk, and you should always do your own research or consult with a qualified professional before making any financial decisions. All right, with that said, let's get into it. So, what is the dividend discount model at its core? Simply put, it is a method of valuing a company's stock price based on the theory that its stock is worth the sum of all of its future dividend payments, discounted back to their present value. In other words, if you could predict all the future dividends a company will ever pay and figure out what that future cash is worth to you today, you'd know the true value of one share of its stock. Sounds a bit like gazing into a crystal ball, right? Well, it kind of is, but it's a crystal ball based on math and reasonable assumptions. The key components we'll need are the company's expected future dividends, the discount rate, and the dividend growth rate. Let's break down each of these. First, the dividends. The DDM is most effective for stable, mature companies that have a long history of paying consistent and predictable dividends. Think of blue-chip companies like Procter & Gamble or Coca-Cola. For these companies, we can look at their past dividend payments to help forecast future ones. Next, we have the discount rate, often called the required rate of return. This is a bit more personal. It's the minimum return you, as an investor, expect to earn for taking on the risk of investing in that particular stock. This rate is usually based on things like the risk-free rate, like the yield on a government bond, plus a risk premium that accounts for the specific company's risk. A riskier company will demand a higher discount rate from investors. Finally, we need the dividend growth rate. It's rare for a company to pay the exact same dividend forever. Healthy companies tend to grow their earnings and, consequently, their dividend payments over time. We can estimate this growth rate by looking at the company's historical dividend growth, its earnings growth, or industry trends. Now that we have our ingredients, let's look at the simplest form of the DDM, the Gordon Growth Model, also known as the Constant Growth Model. This is the most common version you'll see. The formula is surprisingly straightforward. Stock value equals D1 divided by K minus G. Let's unpack that. D1 is the expected dividend per share 1 year from now. K is our discount rate or required rate of return. And G is the constant growth rate of the dividend. The formula assumes that the dividend will grow at this constant rate G forever. A critical rule here is that the growth rate G must be less than the discount rate K. If it's not, the math breaks down and gives you a negative or infinite value, which doesn't make sense. It's impossible for a company to grow faster than the overall economy forever. Let's walk through a concrete example. Imagine a company called Babalian Beverages. We expect it to pay a dividend of $2.50 per share next year. So D1 equals $2.50. You decided that given the risk of this company, you need a 10% return on your investment. So K equals 0.10. And after analyzing the company's history and future prospects, you estimate that it will grow its dividend by a steady 5% per year forever. So G equals 0.05. Now, we plug these numbers into our formula. Stock value equals $2.50, 0.10 to 0.05. This simplifies to $2.50, 0.05, which equals $50. According to the Gordon Growth Model, the intrinsic value of one share of Babalian Beverages is $50. So what do you do with this number? You compare it to the current market price. If Babalian Beverages is currently trading on the stock market for $40 a share, our model suggests it might be undervalued, and it could be a potential buying opportunity. If it's trading at $60, the model suggests it's overvalued, and you might want to wait for a better price or avoid it. Now, I know what you're thinking. Forever is a long time, and assuming a constant growth rate forever seems unrealistic. You're absolutely right. This is one of the biggest limitations of the Gordon growth model. It works best for very stable, mature companies, but not so well for young, higher growth companies that might not even pay a dividend yet or whose growth is unpredictable. For those situations, we have more complex, multi-stage DDM models. For example, a two-stage model might assume a high growth rate for the first few years, say 5 or 10 years, and then assume the company matures and settles into a lower, stable growth rate for after that. Let's quickly touch on how that would work. In a two-stage model, you would first calculate the dividends for each year during the initial high growth phase. Let us say we expect Babalian Beverages to grow its dividend by 15% for the next 3 years. We would calculate the dividend for year 1, year 2, and year 3. Then, we would discount each of those individual dividend payments back to their present value using our discount rate of 10%. After year 3, we assume the growth rate drops to a stable 5% forever. So for year 4 and beyond, we can use the Gordon growth model. We decalculate the dividend for year 4 and then use the formula to find the stock's value at the end of year 3. This is called the terminal value. But remember, that terminal value is a value in the future, at the end of year 3. So, we still need to discount that entire terminal value back to today's dollars. Finally, you add up the present value of the dividends from the high growth phase, years 1, 2, and 3, and the present value of the terminal value. The sum of all those parts gives you the intrinsic value of the stock according to the two-stage model. It's definitely more work, but it provides a more nuanced and realistic valuation for companies with changing growth prospects. You can even have 3-stage models or more, but the principle remains the same. The dividend discount model is a powerful concept because it forces you to think critically about a company's future and what it is truly worth. It's not just about the current stock price or the latest news headline. It's about long-term cash flows. However, it's crucial to remember the model's weaknesses. The DDM is extremely sensitive to its inputs. A small change in your assumed growth rate G or discount rate K can dramatically change the calculated stock value. The saying, garbage in, garbage out, definitely applies here. Your valuation is only as good as your assumptions. Also, the model is useless for companies that don't pay dividends, like many tech startups. For those, you have to use other valuation methods like the discounted cash flow, DCF model, which focuses on free cash flow instead of dividends, or relative valuation metrics like the price-to-earnings ratio. So, is the DDM still useful? Absolutely. It's a fantastic tool to have in your analytical toolbox. It provides a solid, logical framework for thinking about value. Even if the final number isn't perfect, the process of building the model forces you to research the company's dividend policy, its growth prospects, and its risk profile. It's an invaluable exercise for any serious investor. To recap, the dividend discount model values a stock by summing up all of its future dividend payments and discounting them to their present value. The most common version, the Gordon growth model, uses a simple formula: stock value equals D1 kg. While it has its limitations, especially its sensitivity to assumptions and its inapplicability to non-dividend paying stocks, it remains a cornerstone of fundamental analysis for stable dividend-paying companies. I hope this step-by-step breakdown has demystified the dividend discount model for you. It might seem complex at first, but once you understand the core idea that a stock's value comes from its future cash payments to shareholders, it all starts to make sense. If you found this video helpful and want to learn more about investing and personal finance in a simple, straightforward way, please do me a huge favor and hit that subscribe button below. And don't forget to ring the notification bell so you won't miss our next video. It really helps the channel grow and allows me to keep creating content like this for you. Thanks so much for watching the Babalian Money Show. Leave a comment below if you have any questions, or if there is another financial topic you'd like me to cover. Until next time, Invest wisely and stay informed.